Mortgage rates are supposed to be going up. Middle East tensions, inflation creeping back into the forecasts, every reason for lenders to get nervous and pass the costs on to you. And yet, Chris has just locked in a new deal that's cheaper than the one he's on now. I'm Ed, this is Chris, and this is Mouthy Money. Today we're talking through exactly how he did it, the deal he secured, what he does between now and his September deadline, the one thing most people get wrong when you actually have to sign on the dotted line. Now, if you've got a remortgage coming up, this episode is the one that saves you money. Mouthy Money is proud to partner with Coinbase. If you're thinking about getting into crypto, but not sure where to start, consider Coinbase. In just a few taps, you could buy, sell, and hold Bitcoin, Ethereum, and a range of other popular crypto assets, all from right here in the UK. Coinbase is registered with the FCA in the UK, and with world-class security, you can invest with confidence. Whether you're brand new or already building your portfolio, Coinbase gives you simple tools for crypto investing. Join millions already using Coinbase. Download the app today and start your crypto journey. Find out more in the summary. Remember, don't invest unless you're prepared to lose all the money you invest. This is a high-risk investment, and you should not expect to be protected if something goes wrong. This is not investment advice, and it is not a recommendation to buy or sell any particular digital asset. So here's the headline before we get into it. Chris has secured a rate that is lower than his current deal, and he hasn't had to commit to it yet. That's the part people miss. Securing a rate and being locked in are two different things. He got an offer in his back pocket and the freedom to walk away if something better comes along before September. So by the end of this video, you'll know how to get yourself exactly into that position. So let's start with where you are actually right now, Chris, because securing a cheaper rate in this market wasn't luck, perhaps. Walk me through how you got to it.
Right. So about 6 months out from my current deal coming up for renewal. So my mortgage currently ends in early October. About 6 months before, you can start looking around at what other deals might be out there. And certain lenders give you the option to change over. So you can either reserve a rate or you can jump onto that rate immediately. So the first thing I did was I reached out to a couple of mortgage brokers and asked them to keep an eye on the market for me. So after they did some checks on, affordability, what the current payments are, what we wanted to achieve with the mortgage, which was essentially get a lower monthly repayment figure, they then went out to the market and had a look and see what was out there. And speaking to those guys over a sort of a month or two period, it's been noticeable that the rates were slightly lower than what I was on at the moment, which is 4.89% with Santander. And actually, there was a bit of a debate about whether or not to go with a tracker mortgage or a fixed rate mortgage, but we'll come to. But the main thing was that the rates were slightly more expensive. But then as the situation started to calm down in the Middle East, they started to tick down slightly even more. So I'm now reserved a rate which is a 4.64%. So when I say reserved, that means I'm not on that rate at the moment, but I am drifting down towards that in October and have made a decision with my current lender to reserve with those guys. And then I'm watching the situation with real attention, because with all the news that's coming out at the moment, with inflation readings as they are at the moment, there is a chance that rates might actually start to tick down even further. So what I've done is I've reserved a rate that's about £60 cheaper a month to pay.
Yeah. So what I think is really interesting here, Chris, is obviously you've been able to keep an eye on the market at a time when we're in a unique position whereby you were starting your remortgage journey kind of okay, and then we had the entire situation in the Middle East blow up. And what that did was send the mortgage market into kind of chaos. And this has created a big kind of narrative in the press and the media, and kind of, even in talking points when we're kind of sitting in the pub having a pint or whatever, or you and me on our regular Zoom call or whatever it might be, chatting about your current mortgage situation, which we seem to do quite a lot of. But it does this kind of anchoring, doesn't it? Where we all suddenly anchor onto the idea that, oh God, rates are really high. But actually the truth is that the bond market is starting to tick back lower. The mortgage market is following, because obviously swap rates follow on the basis of that. Now, we've had a new Bank of England decision, which was to hold rates, but that doesn't really matter because the bond market, the swap market are already going down. So there's a clear direction of travel here, and this is what you are now finding in your situation with your buying options for your mortgage. And this is what kind of proves the point, isn't it? That you've got to keep shopping around.
Yeah, absolutely. So like I said, it was that 6-month time horizon where it was like, the window's open now to have a look. I'll be honest, like a normal person with 2 kids and a life, I procrastinated for a few weeks and also was slightly overwhelmed with the news and the pace of change that was coming down, and also the prospect of paying an even higher rate, which would be painful, manageable, but painful. And then about sort of 5 months out, I grasped the nettle and decided to speak to these brokers and say, look, what is out there? What is the actual landscape look like? I was surprised to find out it's more or less the same, slightly more expensive, slightly cheaper, depending on who you go for. And then actually, as the situation seems to have been edging towards a resolution in the Middle East and inflationary pressures haven't perhaps spiked as much as you said, and therefore bond markets have moved, and the swap rates, which sit behind the Bank of England base rates as the real driver of a lot of this mortgage pricing, have started to come down. What I found was the closer I watched it, the more that this started to tick down. And then 4 months out, my current lender, Santander, decided that they were going to show me what was available, and that was the rate that I've reserved now. So that would be a straightforward product transfer. I wouldn't need to do an application with anybody. So it's easy, right? Checking rates yesterday, they're still more or less at the most competitive end. I think there were 1 or 2 that were slightly cheaper, but I'm talking very slightly. So 4.64% is my basement now. So that's as bad as things can get, really, if you want to put it that way, or as good, depending on how things go. But now with the situation improving, I think there is definitely space. I'm starting to think more positively that rates could creep down even further. And I'm committed to once a week having a look at what this might potentially look like, checking in with my current lender. I've asked these 2 brokers who I've been speaking to about whether they can keep an eye on deals for me so they can bring those to me. So I feel like I'm in the best possible position to take advantage of any changes in fixed rate pricing at the moment, which is
secured, but you've got months realistically until September before you actually have to really do anything, because you got the deal, but you don't have to lock that in 100%. Most people would just sit on it at this point, but you're not going to, are you? So what's the plan between now and that kind of September deadline?
Yeah, so to be clear, the remortgage is in October, early October, but September, I think there's like a 14-day window. So you can cancel a deal or move to another deal 14 days before it kicks in. So I'm looking at mid-September realistically to be able to do that. I'd have to factor in a bit of time as well if it was with another lender to go through an application process. So probably looking early to mid-September on that, to be clear. That's the practicalities around that. But essentially, it's just monitoring what's happening out there and keep asking questions of those brokers that I've been speaking to about whether or not there's any better deals out there. And if there are, moving on to those. But as it stands, this one's reserved. I've actually gone through the process, click reserve. And when I was going through, there was an option whether I could start the deal immediately or whether I wanted to start the deal at the end. Now, if I started immediately, obviously I'd be making immediate savings on my mortgage repayments. But actually, I'd rather wait and see whether we can eke out a little bit more of a saving with these rates ticking down. The other thing to mention when I was speaking to those brokers, Ed, and racing ahead a little bit here, but the other thing to mention when I was speaking to those brokers was that there was another option of doing a tracker mortgage, which would track the Bank of England base rate. So at the time when I was having that conversations a couple of months ago, things weren't clear about which direction of travel the Bank of England would take. It's now becoming clearer that it's probably not going to be upwards, but there's no guarantees, right? Anything can happen, as the last few years have shown us with the perma crisis that we exist in. But if before I was and we had a debate on a previous pod where it's like, actually, I'd rather have the certainty. But actually, I think this brings this back more into view, because if I've got 3 months left on my window and actually it takes time for these inflationary fears to ease and we're back on the sort of path to a normal global economy, whatever normal means these days, there is a chance that in 6 months' time, rates could be materially lower again, and then 9 months' time, materially lower again. So is there an argument for me to actually have a mortgage that tracks that Bank of England base rate instead? And I could end up paying less over the period of time. And before I was maybe, but probably not. And I'm probably still in that camp. But I think that makes it a more live possibility, just because if I think the trajectory for rates is down now, and it looks like that may be the case, base rate and mortgage rates, then there could be some benefits to be had there, but that's a risk.
This is something we discussed in a previous conversation that we had about your remortgage, and I think it did get fairly robust, let's say, because I understand the point around it, and I think obviously that there is an element here where the calculations might make sense. But I mean, my real feeling on it is that I would always take the certainty of a fix over the kind of the kind of gamble of a tracker. really, because a worst case scenario for a fix is you take a 2-year fix, especially in your situation now where actually the remortgage that you're being offered is cheaper than what you're currently on. That's deflationary for your finances, for your budget. In the practical terms, it means your costs are going down, which is really good news. So I would personally, just kind of grasp that rather than let's see how low things can really go here and let's see what happens. That's just my view.
I tend to agree, and I don't want to be in violent agreement with you here, but I think it is worth raising that as a prospect, because I think, again, we talked before on the previous pod, and I think it's important now. Again, there is this sense that the timing of this is good because there's still 3 months for those de-inflationary pressures to come in and markets to move and rates to get cheaper. So that's good news, right? But there is a part of me thinking, actually, if we leave it over a 6-month time horizon, could that get even lower? Now, you're remortgaging next year, right? So you're probably sat there thinking, well, this is good. I'm going to benefit fully from that, right? Whereas I, at the moment, are looking at tying into a 2-year fix, which means I'd still have to pay an elevated rate in that scenario over a longer period of time, which is a bit painful. I think the reason why I would err on fixing, and that's the decision that I made, is because if I were on my own, then I can adjust to any financial shocks when it comes to sort of income and things like that. But I've got a wife, 2 kids. We're quite heavily committed into lots of different things when it comes to running a 2.4 children household kind of thing. It's not just, it's a bit of a gamble, and I'm taking a gamble on their behalf as well as my own, and I'm not sure that's something I'm willing to do. The other important thing to mention, Ed, actually, though, and this was something that was raised to me when I spoke to the advisor on Santander, was that there are 1-year fixes available. So there's a deal that is slightly more expensive than what I'm paying at the moment, 4.9%. But so that sort of gave me pause for thought. At the time, the situation wasn't as clear that we're perhaps heading towards a resolution in the global economy. That's still 4.9% when I checked yesterday. If that got cheaper, that could be something that I might consider as well, bearing in mind what I've just said to you. So there's a couple of things buzzing around, I think, about potential options there.
Do you know what the real banter outcome would be here, Chris? Is if, sorry, I'm going to go there now because it just came to my head, is if you lock in a 1-year fix right now or at the beginning of July and sign for it, when you come up for your remortgage in a year, I'm also going to be up for a remortgage.
I feel a contest coming on. Who could get the biggest savings?
We're not allowed to do contests, Chris. The regulator doesn't like that. There's no competition on this podcast.
No, of course, sorry. No, absolutely not. Absolutely not.
That would be the funny note, but don't do it. Do what's best for your family finances, please. I just a funny thought that popped into my head there, but...
No, I will. And that 4.9% is not tempting at the moment, but the idea of a 1-year fix, that's sort of interesting. And I think it's important to go into all these different directions because I'm doing a bit of midterm planning here and a lot of stuff has come off this. Part of this process now, I beefed up my protection insurance because I was like, I've made a bit of a saving here, so I'm going to reinvest that into something that's going to create better financial security for my family, to your point. I've had a look at increasing, my critical illness cover was done 15 years ago and it wasn't index linked. So the amount that we would get if one of us got ill is okay, but it's not going to make any kind of meaningful difference. It's not going to give the security that it would have done back then. So now I'm looking at it thinking, actually, can I beef that up? There's also a way that I can put a bit of a lump sum together for Tanya and I, if outside of paying off the mortgage, if one of us were to pass away, or if both of us were to pass away, our children would have some money as well. We could do the economics of that in another pod. But I think reinvesting into that kind of thing is where I'm looking at. So it's not like I'm looking to do anything too drastic. It's just trying to see where I can reallocate some of that to make sure everything's grinding in the right way, providing more security, more future planning for us, but also a bit more disposable income now to do some things we enjoy.
I think what's really interesting here ultimately is the process is quite asymmetrical. You're in quite a strong, obviously the lenders set the rates that they offer, but you as a consumer of mortgages are in a position where you can pick and choose what you want, and you've got essentially like a 6-month window to do that. So like you say, you've done that, you've got your rate, they have to honour that effectively, but you can walk away at any point, which I find really interesting. That's really important that people need to remember in that remortgaging process. It's the bit that trips a lot of people up. You've got that offer, the clock's running, so when is that real point of no return for you now? Do you just, you could just chop and change at any point, right?
Yeah, basically. Until 14 days before I can cancel the current deal that I've got and move on to another one. That's signed, sealed and delivered.
Yeah,
I just have to cancel it. I have to contact them and cancel it. I was at pains to ask that several times because even though I'm in this and I know this stuff, you don't want to be caught on a technicality. So every time I speak to they're very helpful people at Santander about this. They were at pains to say, yeah, you can walk away anytime you want, provided it's 14 days before the other deal's ready to start. And they were very helpful and walked me through the process. In fact, even walked me through making sure I clicked the right button online just to make sure that I didn't do the wrong thing, because I was being hyper cautious about this, because this, as you point out, it's a massively important thing for my family's financial security to get this right. So even me, who's quite seasoned, I was like, I could do with a bit of help on this, and they were quite willing to do it. Yeah, you can shop around. I think the thing is to be aware of it and to grasp the nettle. And once you're in the conversation, it does spark off other, like I said, it's a good time for doing some midterm planning. So it sparks off other conversations and thought processes about what do we need, where do we need to be, what do I need to do to optimize my finances at this stage? And we'll see where we are again when the fixed deal ends and what else we can do. But as it stands, if this is the deal that I end up having, I'm happy with it. Like I said, it allows me to reinvest some money into some critical illness cover. We've shown that we're able to wear that cost because we've been managing it for 2 years now anyway. We've got robust enough family finances that allow us to save into our pensions, into children's JISAs, and into sort of a general cash savings account. And yeah, there's been a bit of lifestyle deflation in terms of cutting off some pay TV and rethinking certain holiday destinations and things like that. But on the whole, well, I think we've weathered this crisis relatively well, touch wood, and we'll continue to do so if we keep on top of this stuff and make sure that we realise when the scales are tilted in our favour, as you said. And mortgages can sometimes feel like a one-way street, like you said, where you're being dictated to by a lender. But actually, on this occasion, this is where you do have a bit of power to move around, right? And you do have a bit of autonomy, and you should take advantage of that.
So I think this is a really important point to flag up, actually, and you've mentioned it. It really is, generally speaking, worth doing it with a broker. They will be professionally regulated to provide you with mortgage advice and help you through that process, access what's the best offers out there on the market. I think the vast majority of people do tend to do it through brokers. Some of them will have charges. I think it tends to be smaller, more specialists that will have charges. Bigger brokers will often actually just basically get a commission from the lender that you agree to go with. So there is an incentive there for you to be aware of, but I don't really think it's a major issue. My broker, I went through a very large one when we got our mortgage, our first mortgage, and we didn't pay a penny for it, and we got a really good mortgage. And you've mentioned there, Chris, that you've worked with these brokers to shop around, right?
Yeah, there's two models really. So one is would charge a fee if the mortgage were to complete. So I could still reserve the rate with them and not pay them a penny, and they can keep looking at it. And they also get what's called a procuration fee. So the lender will pay them for bringing the business to them. So that's nothing to do with me. That's between the lender and the broker, and that's what makes that economic for them, because that's okay. I understand. I don't know what the exact detail is, but obviously it makes it economic for them. And the other one has just said, yeah, there's absolutely no charge for you to do this. We'll get the proc fee and just keep an eye on what's going on with you there. So I think there's two slightly different approaches to that. So one with a charge, one without. But if the rate materially brings something that makes that small upfront charge for them worthwhile, then it's something I'll consider. The other thing I think to mention is fees on the mortgage, Ed. Whenever you come onto a new mortgage, and this is something about the kind of 2-year fixed thing that you probably need to be aware of, or the 1-year fixed, is sometimes these things have product fees, which is anywhere between £999 and £1,500. And what to do with that? So my approach has been to add it onto the loan and then pay it off, overpay the mortgage on the first day. But you can pay it beforehand, and I've got that option with Santander. So even though I've reserved the rate, I don't need to pay that £999 until I'm certain that it's the one that I want to go onto and then pay it off. I did notice if I added it onto the mortgage and then paid it off straight away, that my monthly repayment was ever so slightly higher. And as this has become the thing that I fixated on, that I'm trying to drive that down, I think I'll probably end up paying that up front and then going from there. But it does cost money you either add it onto the loan and pay it off over the long period of time and it compounds with the interest, or you can pay it off up front kind of thing with a slight overpayment. But it's worth bearing in mind that these transfers do end up adding either to the mortgage balance, or you're going to have to find a fair chunk of money to do those transfers. So when rates settle to a level where I'm really comfortable with them, I'll be fixing for longer than 2 years, Ed, I think, and getting on with the rest of my life. But we need to stay vigilant on deals at the moment.
Yeah, so that's it. That's the remortgage. Secured, cheaper, and not quite yet signed. We'll come back closer to this one in September, I think, and we can tell you what Chris decides, the big reveal. Season finale of Chris's remortgage, we can call it. Yeah. If this saved you a few minutes of worry or a few £100, do us a favour, hit like and subscribe and turn on that bell so you can catch follow-ups. And if you're going through remortgage yourself, drop it in the comments. Where are you in the process? What rate are you seeing? We read them and they shape what we cover next, and we do try to respond to everybody. So that's it. Thank you, Chris.
My pleasure, Ed.
We are Mouthy Money, and we'll see you next time.